Did you know that 90% of retail investors lose money in the stock market? Most people treat Wall Street like a high-stakes digital casino, throwing their hard-earned savings into a hot tip, only to watch it vanish overnight. But what if I told you there is a hidden 10% who treat it like a predictable wealth machine? Today, we are unlocking the exact secrets they use to turn small sums into generational fortunes. Welcome back to the channel. For decades, the stock market has been the single greatest wealth creation tool in human history. It has outpaced real estate, gold, and traditional savings accounts by a landslide. Yet, for the average person, it feels like a gated community, a complex, intimidating world of flashing red numbers, confusing jargon, and experts in expensive suits who seem to speak a different language entirely. The truth is, building financial security doesn't require a PhD in economics, a high-frequency trading terminal, or even $1 million starting balance. It requires a fundamental shift in perspective. Investing isn't about beating the system or finding a glitch in the matrix. It's about participating in the growth of the most productive companies on Earth. In this video, we're stripping away the noise. We're going to show you how to move from being a nervous spectator to a strategic owner of the future. By the end of this breakdown, the secrets of the 1% won't be secrets anymore. They will be your personal roadmap to financial freedom. We are going deep into the mechanics of the market, the psychology of money, and the exact strategies used by the world's most successful investors to build lasting legacies. Before we can talk about making money, we have to address the elephant in the room. Why do so many people fail? If the market historically returns about 10% per year, why isn't everyone wealthy? It usually boils down to 3 psychological traps that are hardwired into our very DNA. The first is the fear of loss, or what psychologists call loss aversion. Research consistently shows that the pain of losing $1,000 is twice as intense as the joy of gaining $1,000. This evolutionary trait kept our ancestors safe from predators, but it's a disaster for your portfolio. This fear causes new investors to panic sell the moment a stock drops 5% or 10%. Instead of seeing a sale or a temporary dip, their brain screams, "Danger." They sell at the bottom, locking in their losses, and then they sit on the sidelines while the market recovers, only to buy back in when prices are high again. It is a cycle of buying high and selling low, fueled entirely by the amygdala, the part of the brain responsible for the fight or flight response. Second, we have the knowledge gap. Most people treat stocks like lottery tickets. They hear a rumor on a subreddit, a tip from a neighbor at a BBQ, or a sensationalist headline on the news, and they dump their life savings into a company they don't actually understand. They couldn't tell you how the company makes money, who their competitors are, what their debt-to-equity ratio looks like, or if the company even has a path to profitability. Without a foundation of knowledge, you aren't an investor, you're a gambler. And the house, meaning the institutional investors and hedge funds, always wins against gamblers because they have the data and the discipline that the gambler lacks. The third trap is emotional decision-making and herd mentality. Humans are social creatures. We feel safe in a crowd. When the news is reporting that the Dow Jones is hitting record highs and your cousin is bragging about his crypto gains, your FOMO, fear of missing out, kicks in. You buy in at the peak because everyone else is doing it, and it feels safe. Conversely, when the headlines are screaming about a market crash or a Great Depression 2.0, you feel the overwhelming urge to run. But as legendary investor Sir John Templeton famously said, "The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell." To succeed, you have to do the hardest thing possible. Stay rational when the world is losing its mind. You have to realize that the stock market is essentially a giant machine designed to transfer money from the impatient to the patient. Most people fail because they are trying to get rich by next Tuesday. They look at the daily fluctuations and let their heart rate follow the ticker symbol. But the market isn't a heart rate monitor, it's a weighing machine. In the short term, it reflects popularity and sentiment. In the long term, it reflects substance and earnings. If you can't manage your emotions, you simply cannot manage your money. So, How do we solve these problems? How do we build a fortress that can withstand the storms of Wall Street? We need a system, a blueprint that removes the guesswork and the emotion. Success in the stock market is roughly 20% head knowledge and 80% behavior. Let's break down the principles of a winning strategy that you can implement starting today. Principle 1: asset allocation and diversification. You've heard the phrase, don't put all your eggs in one basket, but in the stock market, this is your only free lunch. Asset allocation is the process of dividing your investment portfolio among different asset categories, such as stocks, bonds, and cash. Within the stock portion, you should be diversified across sectors: technology, healthcare, energy, utilities, and consumer goods. If you put all your money into one tech stock and that company has a scandal or a product failure, you're wiped out. But if you own a low-cost index fund like one that tracks the S&P 500, you own a tiny piece of the 500 largest, most profitable companies in America. If one fails, the other 499 carry the load. Diversification doesn't just protect you from failure, it guarantees you capture the winners. You don't need to find the next Amazon if you simply own the whole market. Principle 2: understanding value. You don't need to be a math genius or a calculus expert, but you must know what you are buying. There are two main schools of thought: fundamental analysis and technical analysis. Technical analysis looks at charts, volume, and patterns, trying to predict the next move based on past behavior. But for the long-term investor, fundamental analysis is king. This means looking at the business itself. Does it have a moat, a competitive advantage like a strong brand or a patent that protects it from rivals? Does it have a clean balance sheet with manageable debt? Is the management team competent and shareholder-friendly? When you buy a stock, you are buying a portion of future cash flows. If the business grows and makes more money over time, the stock price will eventually follow. Successful investors like Warren Buffett don't look at stocks as flickering red and green lights. They look at them as businesses they'd be happy to own, even if the market closed for the next 10 years. Principle 3: risk management. This is the secret sauce that separates the pros from the amateurs. You must determine your risk tolerance before you ever click the buy button. This means understanding how much volatility you can actually stomach without panicking. If a 20% drop in your portfolio would keep you awake at night or cause you to sell everything, you shouldn't be 100% in aggressive growth stocks. You also need an exit strategy or a buy and hold thesis. Why are you buying this stock? What would have to happen for your thesis to no longer be true? If you don't have a plan for when things go wrong, you'll make a desperate, emotional decision in the heat of a market correction. Remember, risk isn't just about losing money. It's about the probability of an outcome being different than what you expected. Principle 4: the magic of dollar cost averaging. Most people wait for the perfect time to invest. They wait for a dip, or they wait for the economy to stabilize, or they wait for an election to pass. This is a fool's errand. Timing the market is virtually impossible, even for billion-dollar hedge funds with supercomputers. Instead, use dollar cost averaging. This is the practice of investing a fixed amount of money at regular intervals, say $500 every single month, regardless of the share price. When the market is down, your $500 buys more shares. When the market is up, it buys fewer shares. Over time, your average cost per share stabilizes, and you remove the paralyzing analysis paralysis of trying to find the perfect entry point. This strategy turns market volatility into your best friend. Instead of fearing a market drop, you start to see it as an opportunity to buy your favorite companies at a deep discount. It automates your discipline and removes the need for bravery. Finally, let's talk about the power of reinvestment. When companies make a profit, they often pay out dividends to their shareholders. The secret of the truly wealthy is that they don't spend these dividends on lifestyle upgrades. They use DRIP, dividend reinvestment plans, to automatically buy more shares of the company. This creates a powerful feedback loop where your money earns money, and then that money earns even more money. It's a snowball effect that starts very slow but becomes an unstoppable force over decades. By reinvesting, You are essentially buying more workers for your wealth-building army without ever reaching back into your own pocket. If there is one secret that changes everything, one single insight that turns a regular worker into a multimillionaire, it is this: the power of compounding. Albert Einstein reportedly called it the eighth wonder of the world, famously stating, "He who understands it earns it. He who doesn't pays it." To understand the climax of an investing journey, you have to understand the math of the hockey stick curve. Compounding isn't linear, it's exponential. Let's look at a real-world example that illustrates this perfectly. Imagine two investors, Alex and Sarah. Alex starts investing $500 a month at age 20. He does this for just 10 years and then stops completely at age 30, never adding another penny for the rest of his life. Sarah waits until she's 30 to start, but she invests $500 a month every single month for the next 35 years until she retires at age 65. Who ends up with more money? Even though Sarah invested for 25 years longer and put in 3 times more of her own capital, Alex wins. Because his money had those extra 10 years to compound early on, his snowball grew so large that Sarah's late start snowball could never catch up, regardless of how much she added. This is the climax of the investing journey. The majority of life-changing wealth doesn't happen in the first 5, 10, or even 15 years. It happens at the very end of the curve. It's the moment where your investments earn more in a single year than you earned in your entire first decade of working. Most people quit in year 3 or 4 because they look at their account and say, "I've only made a few $1,000s. This isn't worth the effort or the risk." They don't see the massive explosion of growth waiting for them in year 20. Success in the stock market isn't about a lucky strike on a penny stock or finding the next Amazon before anyone else. It's about the boring, consistent, relentless discipline of letting your money work for you while you sleep. The real secret to stock market success isn't a complex algorithm, a hidden signal, or insider information. The secret is patience and time. When you stop looking at the 24-hour news cycle and start looking at the 20-year horizon, your entire psychology changes. You stop being a prey animal darting in and out of the bushes, and you become the predator. You realize that every dollar you invest today is a seed that will one day provide the shade you sit under in retirement. The power of compounding is a mathematical certainty, provided you have the one thing most people lack: the temperament to leave it alone. The market is designed to reward those who can sit on their hands and do nothing while the world panics. It is the ultimate test of character over intelligence. We've covered a lot of ground today. We've looked into the dark corners of investor psychology, explored the structural blueprints of a winning portfolio, and witnessed the almost magical power of compound interest. But as we wrap up, I want you to reflect on one fundamental truth. The stock market is not a mystery to be solved. It is a tool to be used. For many, the market represents greed, confusion, or unnecessary risk. But for those who understand these secrets, the market represents something much more profound: freedom. It's the freedom to know that your future isn't solely dependent on a single boss, a single paycheck, or the whims of a local economy. It's the security of knowing that you own a piece of the world's most innovative companies, enterprises that are working day and night to solve problems and generate profit for you. The difference between those who struggle financially and those who thrive is rarely about how much they earn in their day job. It's about what they do with what they earn. It's about education followed by action. You now have the framework. You know that fear is a liar, that diversification is your shield, and that compounding is your greatest superpower. But I want to be honest with you. Knowledge without action is just trivia. You can watch 100 videos like this, you can read every book by Warren Buffett, but if you don't take the first step, if you don't open that account, set up that first automated transfer, and commit to the long-term path, nothing in your life will change. So, you need to make sure to start today. Your future self is either going to look back and thank you for the discipline you showed today, or they are going to look back with the heavy, suffocating weight of regret. The secrets are out. The roadmap is in your hands. You don't need to be lucky. You just need to be consistent. Now, the only question that remains is, Are you ready to finally start your journey toward true wealth? If this video helped clarify your path to wealth, hit that like button and let us know in the comments. What is the #1 financial goal you're investing for? Is it retirement, a new home, or building generational wealth? Don't forget to subscribe for more deep dives. See you in the next video.